Welcome to Managerial Accounting. Today is day 16 of the fall 2022 semester. Last class, we finished chapter 21. And so the chapter 21 problem should be submitted by the end of the day today for grading in CNOW. We are starting chapter 22 and covering that today and Thursday. So the pre-quiz should be submitted by the end of the day today. As always, 60% or higher to get full credit for that. And anything less than 60% is no credit. Then Thursday, the chapter 22 exercises would be due. And as you know, because we talked about this last week, exam 2 will be this coming weekend. So officially, as always, the exam period is Thursday to Sunday. I say as always, but the very last exam is different because it's the end of the semester. But as usual, as with the first exam, the official exam period is Thursday through Sunday, but in reality, you can take that exam whenever you are ready. The exam covers chapters 19, 20, and 21. And so once you finish that chapter 21 problem, everything we do today and Thursday is not on the exam, it's on the next exam. It's unfortunate, but it's just the timing. We only have class twice a week. I can't wait until we take the exam to start a new chapter. We just have too much. We have to keep going. So in order to make that exam period include weekdays and weekends to try to accommodate everybody's schedules, that is the only way that it can happen since the chapter 21 problem isn't due until today. So we are going to be talking about the exam today, and actually I'm going to talk about that first before we get into the new material. As far as the exam, I did schedule a review session, and it is scheduled for tomorrow morning at 9:30 on Zoom. If you would like to attend, if you're free at that time, please sign up in Starfish to attend that review session. Obviously, it's optional. If nobody signs up, there won't be a review session. But if even one person signs up, obviously, then we will have that review session, and I will record the review session. And just like I do for the classes, I will post that video on YouTube and make that link available in the reference materials in Brightspace for those of you who are not able to attend. Please do not skip another class to attend that review session. If you have another class that's already scheduled at that time that takes priority, you can watch the video from the review session. My expectation is in that review session, we will start with the practice set for this exam, and if history serves, what we will do is just work our way through that entire practice set. And ideally, we'll finish that in an hour, depending on how much extra time, how many extra questions we have related to that, depending on who's there. You can also see that there is an extra credit, and I will show this to you, but we have talked about it when we did the reciprocal allocation of support department costs. I told you that would be the extra credit, and that extra credit is due at the same time as the exam. It's not time limited though. So the exam, just like with exam 1, and you'll see with 3 and 4, the exam has a 3-hour time limit unless you have accommodations in place. And so I don't expect or encourage or anything else. I don't want you to do that exam 2 extra credit during that same 3-hour window. Plan to take the exam, finish the exam. If you want to work on the extra credit before or after, that's fine. But I don't want you to think about it like it's part of the exam and has to be completed in that same 3-hour window. So let's take a look at the practice set first. So you can see that there are 12 exercises in this practice set. And just a reminder, if you were either attending the review session tomorrow or watching the video, the exercises that have this .algo at the end, that stands for algorithm algorithmically generated. And so those exercises, the numbers you have in your exercise may be different, some or all of them may be different than the ones I'm showing here in this exercise. So in that review session, I show you the tools, the calculations, the approach that you take, but your answers may be different because you may have different numbers. You may have the same, but you want to be careful. Sometimes some of the numbers are different, but not all of them. As I've pointed out before, you can tell that this exercise came from chapter 19. Actually, the first 7 come from chapter 19, only a couple from chapter 20 and 3 from chapter 21. God bless you. In chapter 19, we had a lot going on because we had the support department allocation, but we also had in 3 different ways of doing that, plus the joint allocation or the allocation of joint costs that are incurred together for multiple products. And we had 4 different ways of doing that. That's why there are 7 exercises from chapter 19. So all 7 of those different calculations that we discussed in chapter 19 are fair game for the exam chapter. And so fewer exercises from the other chapters because there was less different ways of doing things, I guess is a good way of thinking about that. So there's your practice set. It is optional. It doesn't directly impact your grade. I can see who works on them, but I wouldn't necessarily be checking on that. But it is, for most people, this is a very good way to review for the exam, to make sure you remember things that we did 3 weeks ago before October break, and just reinforce that. If you know that you have trouble or had trouble with 1 or 2 different topics that we covered, maybe only do those exercises, but they are here. And I would encourage you to do them as much as needed before trying the exam. Let's take a look at the exam then. So again, oops, let me see. I don't know if I can go back or not. Nope. So let me remind you again. So 3 hours to take the test. Once you click start test now, please don't click that until you are ready to go. The timer starts running, even if you leave your computer, even if you, if your computer crashes, that time starts or continues running. If you have any kind of technical issues taking the exam, like your computer crashes, your internet goes out, you need to reach out to me immediately by sending me an email at the email address on the syllabus, hinzcl01@sunyjcc.edu. Let me know what the trouble is. Sometimes, for example, you might accidentally, something happens with your computer, it submits your exam before you've answered any questions. That happened to someone in financial accounting a couple weeks ago. When that happens, I can go in and just reopen it and let you keep going. Or if necessary, delete it and let you try again. But you need to let me know immediately. Do not wait until Tuesday's class to say, oh, by the way, I had a problem. That's too late for me to help you with that problem. Let's go into the test. As I said, 3-hour time limit. You can see this test has just 26 questions on it. Again, you can see which questions come from which chapter. So if you do need to refer to something in your book, you know at least where to start as far as the chapter. Remember to open your ebook before you open the exam. Once you open the exam, it may block you from opening that book. That's a reason to contact me. If you start the exam, open the exam and then realize you didn't open the book, send me an email. Probably what I would tell you to do if I'm available at that time is submit the exam. I would delete that exam and then you'd be able to start from scratch after opening your book. Please do not feel like you need to, if you forget to open the exam or the book first, excuse me, If you forget to open the book first, please don't feel like you just have to go on with the exam. Reach out to me. I will help if I can. And if I can't get to my computer, because that's not something I can do from my phone, if I can't get to my computer, I'll just tell you, hang on, go ahead and submit it. We'll try again, you know, the next day or whenever I can get to my computer and it works for you. So open your ebook, then open the exam. Let me know if something goes wrong with that approach. As always, you have multiple choice questions, which for the most part, I expect you can read and choose the correct answer. Maybe it requires referencing something in the book, but most of the multiple choice questions do not require that you work anything out. You know, they're not asking for a numerical response. Most of the all of the exercises do require that, and all of the exercises, just like what we do in class, have the free response boxes where you need to type your answer in. Some, like this one, where you have to use the direct method to allocate costs, you may need to do a little bit of work on a scratch paper, you know, on some kind of a notepad outside of the test, and then just put your answers in here. I would recommend, if you do that, if you have notes where you've done calculations, that you number them. So you would write question number 5, do your work, because there are occasions where maybe you just make a copying error into the exam and you want to show me the work that you did. That has happened before, where students are, you know, maybe asking for partial credit on a question, and I'm very happy to entertain that if you can show me, here's what I did, here's where I got that answer, and maybe, like I said, it was just a math error or a copying error. And I'm happy to give you credit for that if you had it mostly right. This exercise, the automatic grading, is not going to give you credit unless you have the right answer. But you can always ask for partial credit if you think that your answer merits that. You can't see it in the exam, and I don't really like that, but you should be aware, certainly when you review your exam, when you reviewed exam 1 after the due date passed, you should have noticed that not every question has the same point value. I wish it would show the point value for you here so that you could see that question 10 is worth 3 points or whatever. I don't know why it doesn't. But you should be aware that the exercises or the questions that take a little more work are also worth more points toward your grade. And so each test is worth a total of 50 points. And with only 26 questions, obviously some of them are worth more points than others. Okay, so you can expect to see questions, exercises on the exam, very similar to ones that are in the practice set. The multiple choice are ones, almost exclusively ones that I expect you can just read the question and choose the correct answer. Any questions so far? Everybody okay so far? Okay, let's look at the extra credit. As I said, there is no time limit on the extra credit, but it is due at the same time as the exam. So, and you only get 1 attempt at it. And you can scroll down here. You do have the check my work button. So I think I mentioned that in class last week. So it is similar to the homework problems where it says only 1 attempt, but you can change your answers up until you hit submit assignment for grading. So please feel free to use this check my work button and then go back and try again if you missed any of the questions. So as I mentioned, when we covered this originally, this exercise is going to ask you to use the reciprocal services method. That's the one where we have to set up the system, simultaneous equations, and substitute one into the other to solve. All right, so that's the extra credit. We talked about the practice set, the exam, and the extra credit. Any questions on any of that? Everybody's good? Okay, so what we're going to be doing next is switching gears, going to our new chapter, chapter 22. As I said, chapter 22 is not on the exam. So everything we cover from this point forward will not be on the exam. And let's get started with chapter 22. So chapter 22 is on budgeting. Budgeting is something that every company, every organization, at least should be doing. And I would say 99% of organizations of any size at all are doing a budget. So we'll be talking about the importance of budgeting to manufacturing companies. That's going to be the main focus of this chapter. But you can imagine how companies that are retail, merchandising companies, or service organizations could also develop a budget. Those budgets for those less complicated organizations are also going to be less complicated. So the manufacturing master budget that we're going to be putting together in this chapter is really as complicated as it gets as far as budgeting. I don't want to scare you. What we do in this chapter is not terribly complicated, mainly because we simplify things. So maybe we are only making one product in one size. And so we only are doing a budget for that one, the production of that one product. Again, you can imagine how you would have to scale that up for a realistic company that makes thousands or tens of thousands of different products in different sizes, different prices, and so on, different packaging. And so we will do each step of the master budget for a manufacturing company, but we keep each budget on the pretty simple. So I assume that everybody understands what a budget is, even if you don't have a personal budget, and many people do have a personal budget. So as a college student, maybe you have a job right now that you're working during the semester, or maybe you had a summer job and you knew how much money you needed to get through the semester if you're not working during the semester. So maybe you have a budget for, ordering out, for going out, for clothes, for, I don't know what, gifts, for transportation, maybe a gas budget, things like that. If you are a traditional college student. If you are a non-traditional student, you may also have a household budget. So you know how much you have to pay each month for rent or mortgage and insurance and property taxes if you are a homeowner, and utilities. Companies are doing exactly that same thing, which is budgeting for how they're going to run the company. Except there's a little bit, maybe a little bit more of an unknown quantity in there for manufacturing companies, or for any company that's engaged in sales, because we don't know how much of during a given period, how much we're going to sell. We've talked about the concept of pull-through production. I'm going to put that phrase on the screen again. We've talked about the concept of pull-through production in an earlier chapter, and it will come up again. Pull-through production means that we produce because we have a buyer for it. We produce the product because we think we have a customer, or we already have an order. So our budgeting shouldn't be based on how much we can produce, but it should be based on how much we need to produce to meet sales. So all of our budgeting, if we're using this concept of pull-through production, all of our budgeting starts with that question of, well, how much are we going to sell? Because there's no way we can determine how much we need to produce. Again, the question isn't how much can we produce, but how much should we produce? And we can only know how much we should produce if we have a good sense of how much we are going to sell. Because we only should be producing to support that expected level of sales. Probably want to build in a little cushion. Maybe sales exceed expectations. We want to be able to meet those sales. But we don't produce because we can. We produce because we have a buyer or an expected buyer. So we've talked about the management cycle before, and there's a couple different ways of looking at the management cycle. But the entire management cycle, we'll get to this on the next slide, but the entire management cycle starts with planning. Actually, maybe I should go to that next slide and we'll come back to that diagram. Everything that happens in a well thought out business starts with a plan. Setting goals. What do we want to have happen? What do we think is going to happen? What do we should probably be setting long-term goals. Now, when I started in the working world years ago, decades ago now, when I started in the working world, long-range goals, most companies had 5-year plans, strategic plans that spanned a 5-year period. Some companies would do a 5-year plan, and at the end of the 5 years, or in year 4, as year 4 was ending, they'd start that next 5-year plan. Maybe even a better idea is companies that do a rolling 5-year, rolling plan, so that as each year ends, you're tacking another year. So you always have X number of years projected out. As I said, when I started in the business world, in manufacturing, the company where I worked had a 5-year plan. Today, in 2022, and this has been the case for a little while now, most companies have moved away from the 5-year plan and actually scaled that back to a 3-year plan. Because what they recognized is things were changing too quickly. And so having a 5-year plan, by the time you got to year 3, year 4 and 5 were out the window anyway. So something had already changed. Either we'd already accomplished those things because we were moving faster than projected, or they were no longer relevant. And so most companies now, at least companies where I'm involved, have a 3-year plan. JCC has a 3-year plan. We just developed a new 3-year plan. It just came out, and it's called Advanced 2025. So it's to take us from 2022 to 2025. All companies should have those goals, and their budgets should be designed around that planning process of what do we need to do to reach those goals. That's the planning part of the management cycle. The next part is the directing or the performing phase, where we are implementing what we had planned and hopefully starting to reach some of those goals that we had set. Not all goals are financial in nature. So some of those plans that I'm talking about, some of those plans may not include monetary goals, reaching a certain level of profit. It might include things like customer satisfaction, might include things like market share. That's something we can actually measure or quantify, but it's not directly financial. It's not dollars and cents. It might be employee satisfaction, employee turnover rates, and things like that. At the very end of the semester, we'll talk a little bit about, so how do we handle those types of goals? We'll be looking at something called the balanced scorecard, where we keep in mind the goals of a variety of constituents or people who are stakeholders in our company. But again, back to this management cycle, the directing or performing phase is where we take those plans that we've made and start putting them into practice, start implementing them, hopefully to help us achieve those goals. In an upcoming chapter, we'll be talking about responsibility centers and specifically about responsibility accounting and holding managers responsible or accountable for the costs and revenues that come under their direct control. The corollary to that then is we shouldn't be holding a manager responsible if he or she doesn't have control over costs and revenues, right? That's not fair. I didn't care for that term, but it's not fair to hold someone accountable for something that is outside their control. Maybe those allocated or assigned costs, some of those might not be appropriate to hold as part of the management's responsibility. Finally, at the end of that process, we need to be reviewing, well, how did we do? When we talk about a budget in particular, we want to compare the actual results from the directing or performing phase to what we came up with in the budgets in the planning phase. How did we do? We need to do that comparison and then report out to the interested parties so that if needed, they can make changes. One of our upcoming chapters, actually it's our very next chapter, is evaluating variances from standard costs. That's going to be, that whole chapter is going to be part of this controlling phase where we are evaluating and communicating our results to the interested parties to let them know, here's what you said in your budget. And that's, we're holding you to that. That's what we expected you to do. Here are your actual results. Here's where they differ. Here's our explanation for why they differ. And now what are you going to do about it? And sometimes, certainly, our actual results will be better than predicted or better than budgeted. So I don't want it to sound like those variances that we identify in the controlling phase are always negative. Sometimes they're going to be favorable variances. And again, we'll be talking about that next week. So this is, as you can, oh, whoops, I wanted to go back to that. So just to summarize how it fits, how the management cycle fits in with budgeting, we have to establish specific goals and then execute plans to help us get there and then see how we did. That's an important feedback loop, as you can see on this slide, because the feedback needs to inform the next cycle. So there's something called zero-based budgeting, and we're not getting into the nitty-gritty of this, but zero-based budgeting means, very simply, each cycle, each year for most organizations, you have to justify your entire budget. Contrast that with baseline budgeting. So baseline budgeting means that you start with whatever you had last year and you have to justify increases to last year's budget. Baseline budgeting is, again, I'm simplifying a lot, but baseline budgeting is what is used by the federal government. That's how you can hear things like they're talking about cutting whatever services. They don't mean an actual cut generally. What they mean is they're slowing down the projected rate of increase. So we thought we were going to get a 10% increase over last year. We only got an 8% increase. They'll call that a cut because they're using baseline budgeting. And the assumption is you start with whatever you had last year and then we build on top of that. Zero-based budgeting means we start assuming that there's nothing in the budget and you have to justify everything that you're asking for in that budget. It's not assumed that you just get what you had last year and then some. You see the difference between those two? Baseline budgeting and zero-based budgeting. It's a pretty dramatic difference, really. But it's this whole feedback loop is very important to make sure that we're learning from what happened in the past. That if we didn't meet our budget for last year, but then we start with last year's budget and add to it, we're probably dooming ourselves to failure. So it's very important that we implement that controlling phase. What did we learn from what happened? Here's our planned results, that is our budget. Here are our actual results. How do they compare? Why are these numbers different? And in the case of a favorable variance, we want to know why they're different, because we want to know, is this going to keep happening? Can we expect to see these favorable variances continue? What can we do to make sure they continue? And on the flip side, if it's an unfavorable variance, if our revenues are lower than we had planned, or if our expenses are higher than we had planned, we also want to be looking at that to say, why did that happen? What can we do to make sure it doesn't happen again? And it may be that our budgeting was at fault, and it may be that there was something unexpected that occurred, like, I don't know, inflation of 8.5% that we didn't build into our budgeting for this year because it wasn't expected, it wasn't planned. Okay. Couple different types of budgeting that I want to talk about. And let me put these terms on the screen. So there's the authoritative, or what you might call top-down approach to budgeting. And we want to contrast that with participative budgeting. So I think of authoritative budgeting like this. The top management, maybe it's the CFO or the controller, there's a budget committee composed of the individuals who are ultimately in charge of producing that budget. And the way I picture it is they sit in the back room with the lights dim and nobody's allowed in, and they just say, what do we need? What does our board expect for next year? Or what are stockholders expecting for next year? And they start with that bottom line in mind, and they build backward. We want to make X amount because that's what the board of directors, that's what our stockholders ultimately want to see. Okay, let's back into the numbers that we need to hit to make that happen. And then they come out of the back room and they pass out everyone's budget and say, here, make it work. They didn't consult with anybody. They didn't talk with sales about how much they expect to sell. They didn't talk with any of the production facilities about actual costs. They didn't look at how costs might have changed from last year to this year. They did it in the back room, and then they foist that budget off on everyone and say, okay, make it happen. Think about if you were that person. If you are a production supervisor, let's say, and the foreman comes out and hands you a budget and says, here, this is what you have to do this year. I think human nature is going to make you say, nope, not going to happen. That's not going to work. I think many people, especially in that kind of a work-related situation where you're going to be told that you're held accountable or responsible for something that you had no input, your natural reaction is going to be, that passive-aggressive, nope, not going to work. Contrast that with participative budgeting, which is exactly the opposite of what I just described, where we start with the sales department and we say, how much do you think we're going to be able to sell of these products this year? What's demand look like? What's happening in the marketplace? Because ultimately our sales staff are the people who should have their finger on the pulse and know how much we should be expecting to sell, right? So that's where we should start. If we're using pull-through production, if we're using participative budgeting, the entire process should start with sales. And so the first component of the master budget, so the master budget, as you can imagine from the term, the master budget is a compilation of a whole bunch of smaller individual or operating budgets. And along with those, we're going to do some pro forma or budgeted financial statements based on the operating budgets. And so this set of budgets that make up the master budget, the very first one that every subsequent budget should hinge on, the very first one should be the sales budget. And that sales budget is by necessity going to include how many units do we expect to sell at what price. And the reason it has to include both price and units, we can't have a sales budget without a price. We can't have a completed sales budget without a price, is because if you know anything about economics, and this has come up several times over the past couple of weeks, the law of demand tells us all else equal, higher price equals lower volume, right? People are willing to buy less of it if we raise the price. So it's not possible to have a sales budget that does not include a price, because we can't answer the question of how many units are we going to sell if we don't know how much we're charging for them. Make sense? Once we know how many units we need to produce, we can go on to the production budget. Excuse me. Once we know how many units we're going to sell, we can go on to the production budget. How many do we need to produce to support that anticipated level of sales? Once we know how many we're going to produce, we can add to that master budget a budget for human resources, so a direct labor budget, a budget for materials, and we can take that one step farther, so we can have a budget that shows how much materials we're going to use, and then how much material we might need to purchase, because those numbers might not be exactly the same. We might be building in a planned change in inventory, either using up some inventory we already have or stocking up additional inventory for the next period. So we've got sales, then production, then both direct materials and direct labor budget. Those can really be prepared at the same time. Then we can look at the other operating expenses like selling, general and administrative expenses, manufacturing overhead, a budget for that. Once we have all of those operating budgets in place, we can then use that information to prepare a pro forma. I'll write that on the screen in case you're not familiar with that word, pro forma, which means budgeted, pro forma financial statements. And we would do those in the same order: an income statement, a balance sheet. We also will be looking at in this chapter a cash budget, so that we make sure not only that we're addressing our profitability on the income statement, but also our liquidity, our cash needs because remember, we use accrual-based accounting. And so our cash flows may not match up exactly with our income statement. So we do need to make sure that we have enough cash to continue to pay our bills and stay in business, that we meet our liquidity needs. Okay. Let's go to our exercises. That's enough of listening to me talk for a few minutes at least. And for most of the rest of the chapters, certainly for the rest of today, we're just going to be working through our exercises. Actually, give me one more second. There's one other thing I should talk about before I leave this PowerPoint. I need to skip ahead. We talked about that already. That's where I wanted to be. Okay. So before we go to our first exercise, I do need to talk about static versus flexible budgets. So static means it doesn't change. For our budgeting purposes, a static budget means we budget for one level of activity, and that would be based on the projected sales. So we would get that one number, projected sales, from our sales department, and then we would build each one of the other operating budgets based on that one number. Well, we've been talking about over the last few chapters, the difference between variable and fixed costs. And as we look at this static budget, we're going to see the impact of not taking into account that we might not actually produce and sell exactly the same number of items as we planned for. And so this is an example of a static budget. We have one number for each one of those items: direct labor, electric power, and supervisory salaries. You might be wondering, why does this budget not have any revenues in there? Why is it only costs? Why is it only expenses? And the answer to that question is based on that idea of responsibility centers that I mentioned a few minutes ago, responsibility accounting. This budget is for the assembly department. The assembly department doesn't have sales. They're not responsible for sales. They're not responsible for revenues. And so the manager of this assembly department would only be held responsible for the costs that come under his or her direct control. There are no revenues to the assembly department. They're not selling anything. There's one piece of helping to make the product. So what else do we know about these costs that are listed here specifically? Direct labor, is that a fixed or a variable cost? Is direct labor a fixed or a variable cost?
Variable.
It's variable. If we make more product, we're going to have more direct labor. If we make less of the product than we're expecting, that direct labor cost should be lower. So let's think about this before we move on. Let's say that this budget is based on making, just to make the math easy, let's say it's based on making 40 units. So this direct labor would be $1,000 each for the 40 units we expect to make. If we only make 30 units and our direct labor comes in at $35,000, we compare that $35,000 to the $40,000 we have in the budget, and we say to the manager of the assembly department, good for you. You saved $5,000. Is that how we should be reading that? No, because his cost per unit was actually higher than the $1,000 that we built into this budget. Again, using my numbers. I'm totally making that up based on what's here. We really should have expected him to only, or her, to only spend $30,000 on direct labor if he made only 30 units rather than 40. Does that make sense? So in a way, we'd be rewarding him for only making 30 units and keeping under the $40,000, which is totally inappropriate. And it's definitely not the behavior that we want to reward. Why do you think, in my example, what would be the rationale for making only 30 units instead of the 40 that we built into this budget? Why would he have, or she, why would the assembly department have only made 30 units, do you think? If this budget was based on 40, why would they have made only 30? I can think of a number of different reasons. We don't know exactly the answer. I'm just asking you to think about it, conjecture, just guess. Yep.
They were projected to only like sell.
Okay, so when they were doing the budget, when they were in that planning phase, they thought they were going to make, they thought they could sell 40, but then new information came in and demand had dropped, and so they could only sell 30. That's a very legitimate reason for only making 30, because you can't sell 40. You don't want to make 40 just because you have the capacity. You remember we talked about 3 different kinds of capacity: theoretical, practical, and normal. So you don't want to make 40 units just because you can. You want to make 40 units because you can sell 40 units. So Carter's explanation that maybe they only made 30 because that's all they determined they could sell, that's very realistic. It's unfortunate, but we would expect if this department can only, if they can only sell 30, that this department then would only have made 30. Why should we make an extra 10 and put them in inventory? What's another reason that they might have only made 30? Thinking about what you know about what's going on in the world right now. This,
Just like supplies.
okay, so we have a supply chain issue right now, so it may be that they couldn't get the materials they needed to make the product. Okay, so this is the assembly department. You notice there's nothing in here about direct materials, because that's done in the fabricating department, maybe, whatever feeds into this assembly department. But it is entirely possible that they couldn't get, again, I'm making all this up in my scenario in my head. But it's entirely possible that maybe they only made 30 units because they couldn't get the parts, because the fabricating unit couldn't get the materials, the raw materials it needed to make the product. Maybe it's a labor issue. And we see that happening in today's world as well, that you can't get enough people to staff this department. Neither one of those two scenarios is a good scenario, obviously. We don't want to have a supply chain issue or a labor issue. But both of those would be very understandable explanations for why the assembly department made only 30 units rather than the projected 40. And we would not want the assembly department to still spend $40,000 on direct labor if they only made 75% of the units they were anticipated to make. They should only spend 75% of that direct labor. Is this making sense? Let's look at the other two components there. Electric power. We frequently think of electric power as being a mixed cost. And so in the earlier chapter, we did use the high-low method. That's going to be on your exam this weekend. We use the high-low method to separate those mixed costs into their fixed and variable components. If electric power is a mixed cost for this assembly department, if there's a baseline electric, it's the fixed cost, and then there's a per unit electric on top of that, we would also want to tease those apart. It's not necessary in the static budget that we're looking at now, but it would be necessary in a more appropriate budget called a flexible budget, and that's what we're going to look at next. How about supervisory salaries? Fixed cost or variable cost? It is a fixed cost, yes. And that word salaries is your key to that, because a salary means you get paid the same regardless of how many or how few hours you work, as opposed to wages that are generally on a per hour basis. So looking at this static budget, and let me make one more observation before we move on to how we could improve on this. I've been talking about the scenario where we expected to make 40 units and we actually only made 30. What if we made 50 units? And this budget's based on 40 units. If we made 50 units, do you think we still spent only $40,000 on direct labor? No, probably maybe 50,000, right? Maybe there's some economies of scale, but probably close to 50,000. Then electric power, let's assume it's a mixed cost. The part that's fixed really should remain the same, whether we make 40 or 50,000. But the variable part is going to increase if we up our production. Now the supervisory salaries, because they are a fixed cost, that should remain the same, whether we make 40 or 50,000 units. But if you're the manager of the assembly department and your department cranks out 50 units instead of 40, and let's say they spend $42,000 on direct labor, if we're relying on this static budget, that manager is being reprimanded. Hey, you went over budget. What's going on here? Why did you spend so much money? Your budget was 40,000. It doesn't recognize and take into account that the variable costs are expected to increase if we make more, and they should, by the same token, decrease if we make fewer units. It doesn't react to changes in our level of activity. And so it's not a very good management tool if it isn't reacting to a change in the production level, which is really outside the control of the assembly department. The assembly department makes how many units they're told to make. They're not in charge of sales. They're not in charge of procuring the parts. And so to hold them responsible for a change in the level of activity is not fair. Again, I'm using that term. It's not an appropriate way of managing if you're not taking that into account. It comes back again to that concept of responsibility centers and responsibility accounting. We can't hold the assembly department responsible for something that's outside of its control. And so let's move on then to the concept of a flexible budget. So the flexible budget takes into account what would happen. It projects what would happen if we made, again, in my example, 30,000 or 50,000 units. What would we expect to happen to the budget? And so we know what that means. We know what that means, that the variable costs, and you can see that they did in this budget, split the electric power. Part of it is a variable cost and part of it is a fixed cost. And you'll notice that the fixed cost, part of the electric power and all of the supervisory salaries are constant regardless of our level of activity. You can see here, they didn't use 30, 40, and 50 like I did to keep the math simple. They used 8, 9, and 10,000 units. But you can see again that it takes that into account and reduces the variable costs when our production is lower and increases them when our production expectation is higher. This then allows us to appropriately manage our department, in this case, the assembly department, that we're actually comparing realistic numbers for each one of those expected levels of production. The original budget, by the way, is level 1 here. You'll notice with the 40,000 in direct labor and the combined 5,000 in electric power. That is not how I would have done it if I was doing this example. I would have made the static budget be the middle column. And here's why. I like to think of this as best case scenario, we make 10,000 units. Worst case scenario, we make 8,000. And expected value is the middle one. So it's kind of weird that they included the static budget as the lowest possible, as if we couldn't produce less than that, but we might produce more. One last comment about this, and then we'll finally get to our first exercise for today. This 8 to 10,000 units corresponds with what we have referred to in earlier chapters as the relevant operating range. The relevant operating range, best case to worst case to best case scenario, and somewhere in between. Finally, we can take this information and translate it into a very quick and simple, what's called the flexible budget formula. And I'm going to write that down here at the bottom of the screen. Flexible, maybe, budget formula. For this exercise, well, for the flexible budget formula, the basic equation would be fixed costs plus variable cost per unit times number of units produced. And so our fixed costs, you can see right here, regardless of our level of production, we expect the fixed cost to be $16,000. Oops, not 26,000. I am really having trouble typing today, apparently. 16. Jeez. There we go. And our variable cost per unit. Well, our variable costs include direct labor at $5 per unit, plus electric power at 50 cents per unit. And so that would be a total of $5.50 times the units produced. That would be the flexible budget formula for this assembly department budget. How is that helpful? Well, let's look at this. The units of production that they give in the budget are 8,000, 9,000, or 10,000. Do we think there's a high likelihood that we're going to produce exactly 8 or 9 or 10,000 units? Exactly that one of those numbers? Probably not. Probably not. Maybe it's 8,996. Probably not exactly 9,000. And so this flexible budget formula gives us a way of quickly projecting by plugging in for units produced the actual number, 8,996 maybe. If we are doing this in Excel, and clearly this is an excerpt from an Excel spreadsheet, if we were doing this in Excel, we would have these set up with formulas, so it was very easy to just plug in a new level of actual production as well. Now we can go to our exercises. Maybe I can get out of here. I'm going to show you one more thing. If we go into Brightspace in the content area, in the reference materials, in the folder, whoops, wrong one. In the folder for chapter, oh, it's not in there. Darn it. In the folder for chapter 22, I should have checked before class. I will put the formula for calculating a flexible budget. And I don't know what happened to it because it was in there last semester. So what you see on the screen right now here, this information about how to calculate it's not what I want the calculation. That's not exactly what I'm going to put in there. I thought the calculation was there. So the calculation for how to convert from a static budget to a flexible budget. Essentially what we would do is take the dollar amount for the variable costs, the dollar amount in total, and divide by the level of production to find that per unit cost. Okay, so that's the calculation that needs to be there. The total dollar amount from the static budget divided by the number of units gives you the cost per unit. You can then use that just like we did here, $5 per unit, 50 cents per unit, to project what the total budget would be at the various levels of production. So I'll make sure that that gets into that reference materials folder. And I apologize, it's not in there now. I thought it was. Now let's go to our exercises. Starting with exercise 1, static budget versus flexible budget. The production supervisor of the machining department for Hagerstown Company agreed to the following monthly static budget for the upcoming year. So this is for the machining department. We have wages. Those wages are going to be a variable cost. We have utilities, which is probably a mixed cost, as we've been discussing, and then depreciation, which would be a fixed cost. The actual amount spent and the actual units produced in the first 3 months were as follows. So we should have been spending, according to the budget, $2,358,000. You can see that for each one of the 3 months, first 3 months for this company, the spending was lower than budget. If we just use a static budget and we look at that, we're going to be saying to the machining department supervisor, great job. You kept the expenses below the 2.4 million every month. And you can see that the machining department supervisor's been very pleased with this performance because they're less than that monthly static budget. However, the plant manager believes that the budget should not remain fixed for every month, but should flex or adjust to the volume of work that is produced in the machining department. We've just gone through why that makes sense, why we should be using a flexible budget, why we shouldn't be rewarding the machining department supervisor for being under budget when maybe the production levels were lower than anticipated. And so you can see here that we have wages per hour. So what they have done, excuse me, even though they did not tell us, they do not tell us how many units this static budget was based on, we could actually calculate that based on the information that we have here. So just to show you that quickly, just to show you that quickly, we have, whoops, I can't see it. Give me 1 second. We had a budget for $2,250,000 in wages. And if we want to know how many units we were expected to produce, we can see that the wages per hour was $25, and we expected each unit to take 1.5 hours. So 1.5 times $25. Oops. Is $37.50 per unit. If we divide that into the 2,250,000 units, $37.50 each, our budget was for 60,000 units. That budget, everyone follow that? Everyone okay with that calculation? So our budget of almost $2.4 million was based on producing 60,000 units each month. But in the first month, they produced only 2/3 of that, 40,000. It's gone up each month, and you'll notice the actual costs have also gone up each month. But our production in the third month, in July, was still significantly lower than the budget was based on, the 60,000 units that we expected to make each month. And so I would agree with the plant manager who says, yeah, we shouldn't be spending anywhere near $2.4 million when you're producing that much less than the anticipated 60,000 units. So what we're asked to do now for this exercise is to prepare a flexible budget to show what, if we used a flexible rather than that static or fixed budget, if we use that flexible budget, how much should we have spent? How much should we have included in that budget? So we're going to do the supporting calculations first, because if we don't do those, this is where the information is going to come from to move up here. So we know that we have 3 different costs that were included in the budget: wages, utilities, and depreciation. So I'm going to include each one of those: wages, utilities, and depreciation. And we'll come back to fill those in after we do the calculations here, at least for wages and utilities. So how about depreciation? Where is it? Depreciation is listed at $36,000. And the assumption is that that $36,000 is a fixed cost. So I'm just going to go ahead and enter that here. If it is a fixed cost, and it tells us right here that that is the case, assumed depreciation is a fixed cost, then it should be the same in each one of those 3 months, regardless of how many units we produced. But let's look at the wages. Each unit, we're told, takes an hour and a half. So we can calculate the hours of production there. By multiplying the units by 1.5 hours. And we're told that the wages are $25 per hour, so we can go from there. God bless you. And once you have those total wages, you can transfer those up to the actual budget. And you can see, if you can contrast those wages with the static budget wages of $2,250,000, the flexible budget recognizes we're producing less. That direct wages or direct labor is a variable cost, and it should be lower each of those months. And our utilities, we're told that the utilities cost per labor hour is 80 cents. We're not given any information about a fixed part of that cost. Let me just do a quick calculation here. So I said the budget was based on 60,000 units at 80 cents each. So there should be oh, 60,000 units. I'm sorry, 60,000 units. Yeah, okay. Oh, they did tell, see, they did tell us the planned monthly unit production. I just hadn't noticed that before. So it's 60,000 units. Oh, okay, there we are. Utility cost per direct labor hour is 80 cents. Okay. So our total hours of production, I'm with the program now. Total hours of production, we already calculated line 2 of this table. Oops, this line 2 of this table that we're working on. So I'm just bringing that number down. If we were using an Excel template, we would just use a cell reference to pull that down, which would be much more efficient in the long run if we had to make a change. The utility cost per hour of production, we're told, is 80 cents. And once you have those, you can pull those totals into the budget itself. Whoops, budget up here. Again, if we used Excel, we'd want to just use formulas to pull those in. Last step for part A, add those. So we have the monthly budget amounts. And so now what we can see with that flexible budget is each month, the expected spending goes up, but even in the third month, it's nowhere near the static budget amount of 2.25 million, right? 2.4 million. 2.25 was just the wages. So everybody okay with the calculation of that flexible budget? Based on the actual level of production, this is how much they ought to have spent. The next part of the exercise is to compare those flexible budget numbers. Let's see. To their actual spending. I just got all this copied, right? And you'll notice for each one of the 3 months, their actual cost exceeded what the flexible budget indicates they should have spent based on the actual level of production, not the 60,000 they plan to produce, but the actual level of production. So the last line, excess of actual cost over budget. This exercise does not tell us whether to show those as a negative or a positive. In the next chapter, when we start talking about budget variances and variance analysis, you'll want to be careful about the negatives and positives. At that point, I believe the software is going to say that you need to show it as a negative if it's an unfavorable variance, at least in some exercises. Because of the way they've phrased this, excess of actual cost over budget, we really wouldn't want to show that as a negative because that would imply it's not. The actual cost is not over the flexible budget. So what does this comparison suggest? Is the machining department performing better than originally thought? No. Better than the static budget? Yes, but not when we take into account that we would anticipate the variable cost to be lower in months that we produce less than expected. Is the department spending more than would be expected? Yes. And so hopefully this example is a very clear example of why a flexible budget is really important. We don't want to be punishing behavior of producing more than planned. To the extent that that extra production is because we had sales higher than anticipated. Again, as we've pointed out in earlier chapters, shouldn't be producing just for inventory. Absorption costing allows you to mask that by shifting some of the fixed costs to inventory. We don't want to reward that behavior. But we do want to reward behavior that includes making more units than planned because we can sell more units than planned. And let's keep going. So at this point, we have already talked about the ordering of budgets. So what's an appropriate order for those budgets? We know that the sales budget should drive all of the other budgets. The sales budget should drive all of the other budgets. We can't know how much to produce until we know how many units we're going to sell. We can't know how much we need for direct materials and direct labor and manufacturing overhead until we know how many units we're going to need to sell. going to plan to sell. That should point out to you why it's really important that our sales budget is as accurate as possible. And when that sales budget gets blown up, so for many, many, many companies, 2 years ago when COVID hit, their budgets were out the window and had to be completely retooled. Some because sales increased, like online shopping increased, right? People started buying groceries online and doing things like that, totally unanticipated in their budgets. Other stores, other companies were forced to shut down through the pandemic, throwing their budgets out the window. We want to hold companies or managers accountable for the costs and revenues that are within their control. But we also need to recognize that sometimes, through no fault of anyone's inside the company, the expectations might change. And so we know that we're going to start with a sales budget, and that's where we're going to start here in exercise 2. Sonic Incorporated manufactures 2 models of speakers, Rumble and Thunder. Based on the following production and sales data for June, prepare first a sales budget and then a production budget. And I hope it's clear that we couldn't do the production budget before we have the sales budget. So let's start with the sales budget. First, Rumble in the Midwest region, they expect to sell 12,000 units. Remember, I said you cannot have a sales budget that does not include the selling price, because the selling price influences how many units we will sell. So in the Midwest region, we expect to sell 12,000 units at a sales price of $60 for Rumble. Do the extension, a total of $720,000 in sales of Rumble in the Midwest region. Similarly, for the South region, we expect to sell 14,000 of those units. Oops. Again, at $60 each. That's a total of 26,000 units of Rumble. And a total dollars in sales of $1,560,000. That sales figure is going to feed into the income statement. So remember, I said at the end of putting together all of these production budgets, we're going to take this information and be able to prepare budgeted financial statements. This number of the sales, the revenue here for Rumble is going to feed into that income statement. And then we're going to do the same thing for Thunder. So go ahead and do that part on your own. And so we end up with a budget total revenue from sales of $2,235,000. Again, that number is going to help us to construct our income statement when we get there. That revenue number. Everybody okay so far? Okay. So we know that the sales budget has to come first. We know now that we need to be able to support these sales of 26,000 units of Rumble and 7,500 units of Thunder. Now, I should also point out that these budgets, we need to keep in mind, and this is something we talked about back probably the very first day of new material for this class. Unlike financial accounting, which are those general purpose financial statements, one size fits all, they're made for a wide audience. That's why they're called general purpose. They're made for lots of different decision makers making lots of different kinds of decisions about our company. And so this kind of prescribed the way we need to prepare and produce those financial statements so that people know what they're looking at, right? But for managerial accounting, it's only meant for internal decision makers. And so it's really important that for each type of report that we might prepare in a management accounting role, that we keep in mind the audience. So who is it that's going to be looking at this information? The board of directors of our company might want to look at this level of information. 26,000 units of Rumble and 7,500 units of Thunder, total revenue $2,235,000. That's a pretty bird's eye or macro level view, right? If you are a production supervisor, a second shift supervisor at one of the plants, I don't know if there's more than one production plant here or not, but at one plant, the supervisor on second shift doesn't want to know our total revenue will be $2,235,000 this year. What that supervisor needs to know is, how many units do we need to produce this week or each shift today to support those sales? And so just knowing that we're going to sell 26,000 units of Rumble this year. Oh, it's actually only the month. Sorry, it says for the month. 26,000 units of Rumble this month. We might need to know even more detail than that. We might need to know how many units we expect to ship each week, just as an example. And certainly if this budget was for the whole year, we would need to know, is this a seasonal product? I have no idea for speakers. Maybe you sell more in the summer because people are outside. Maybe you sell more at Christmas time because they make a great gift. I have no idea. But the company ought to know that. The sales force at least ought to know that. And so you might need a little more detail for some decision makers. So we need to really keep in mind the audience for this information. Okay, let's move on to the production budget here, which is next. So when we are doing a production budget, we need to keep in mind any planned changes to our level of inventory. And so we start with, well, how much inventory do we expect to have at the first of the month? This is inventory that's available for sale. And we can see here for Rumble at the beginning of the month, they expect to have 750 units already on hand. Maybe I need something there. All right, I need to put those in opposite order. They don't usually do that to me. It doesn't matter because we're adding these together. It doesn't matter which one comes first, but since I saw the heading estimated inventory June 1st, I thought that was going to be what went on this line. It doesn't matter which order you put these. For Rumble, we expect to sell 26,000 units and have 750 already on hand at the beginning of the month. At the end of the month, it's one of those situations where I know what the calculation is, but I'm trying to figure out in what order they want it to go here. Not finding headings that make sense. I can do it this way. Okay, this will work. Apologies. Okay. That's gonna work. Okay. This will work to get to the number that I need, which is the total units to be produced. So if we're going to sell 26,000, we want 500 left at the end of the month. We need to have available. So I don't like this heading, total units available. It's the total units needed is 26,500. But we already have 750 available at the beginning of the month. Yep. And so how many do we need to produce? 25,750. So we're subtracting that estimated inventory from the beginning of the month. Here's another way of looking at this. We're going to start the month with 750 and we want to end the month with 500. In other words, we're going to sell 250 from our inventory. We're selling down our inventory. So the units we need to produce are actually fewer than the units we plan to sell because some of the units we sell are coming out of our beginning inventory. It's not quite as simple as that. Because, and you can go ahead and fill in the same information for Thunder. It is not quite as simple as that. The production budget, yes, we know how many units we need to produce. But from an accounting standpoint, we would have to know what inventory method they use to do the direct materials part of the budget. We know how many units we need to produce, but we can't do a cost of goods sold budget, which will be part of our budgeted financial statements. We can't do a direct materials usage budget without knowing the inventory method they use. And I'll remind you back in chapter 6 in financial accounting, the inventory methods that you learned in that chapter, LIFO, FIFO, and average cost influenced the flow of cost through our accounting records. So let's go ahead and fill in this information for Thunder. So we want to have 250 left at the end of the month. And we expect to start the month with 300. So we're going to sell 50 from our inventory, which means our units to be produced, again, is less than our units to be sold because we're selling 50 out of our beginning inventory. Questions on that so far? Let me go ahead and get my green check marks and whoops. Did I copy those? Minus, they want the minus. Did it say to use a minus? Oh, it does. The software is good about that, telling you that it needs to, you need to use a minus sign. I just didn't know, didn't see that there. So use a minus sign if you want to subtract. It does, I have yet to see an instance in this software that it doesn't tell us when it wants you to use a minus sign. Typically, if it doesn't say, it will accept with the minus, the negative, or without it. Everybody good so far? So we start with sales budget, then we can do the production budget. Couple comments about this. So I already said that the sales budget, the sales volume and selling price information comes from our sales department, our sales staff. Those are the individuals who are responsible for sales. Those are the people who should be providing in the participative budgeting that we started discussing at the beginning of class. We need to go to the people who are the ultimate source of that information, the people who we're going to hold responsible. The sales department gave us this information about sales volume. If it turns out to be wrong, it's the sales department who's going to be held responsible for that, because they're the source of the information. As we move into the production budget, management is going to make decisions about the desired ending inventory. And they're also going to be forecasting the desired, or the estimated beginning inventory. Where does that number come from? Well, what did we say we were going to end with at the end of May? That becomes our estimated inventory for the beginning of June. But again, management is going to tell us how much inventory we want to have available at the end of the month. That may be impacted by seasonal changes in our demand. So if July is a really big selling month for speakers, I have no idea. But if it is, then we probably want to end June with a good quantity of speakers already on hand so we can meet that early demand in July before we start actually having more available. We also want to have enough of a cushion so that if May's sales exceed expectations, we can meet that demand. So we want to have a bit of a cushion in there as well. But my point is, we need to be seeking information to complete these budgets. We need to be seeking information from the responsible parties. Who are we going to hold responsible in our participative budgeting? Who are we going to hold responsible for meeting these projections? Those are the people we need to be asking. Now, it doesn't mean that they hand us a budget and we just say, okay. We might need to have some negotiation. We might need to work together so that everybody's happy, including the board and the stockholders are happy with our projections. But we need at least to be seeking input and feedback from the people that we expect to implement these budgets. Once we know how many units we need to produce, at that point, we can start talking about, well, how much direct materials will we need? How much direct labor will we need? The sources of that information are different. Direct materials and direct labor. Who's going to tell us how much we're paying our workers? Well, human resources. They can give us the average wages. They can tell us, hey, you know, some of our workers are paid minimum wage or close to minimum wage, and minimum wage is going up the first of the year, or July 1st. And so we need to take that into account. We need to build in those labor rate increases. They're the ones who would know if we have a contract with our unionized employees and the contract has a built-in 3% raise as of July 1st. And so we can build that into our budget. We need to take that kind of information into account, and human resources would be the source of that. As far as how many hours we need for direct labor, who's going to tell us that? Well, the production people are responsible for that. So we're going to ask them, how long does it take your workers to produce this? And they're going to give us, it's an hour and a half, like in that last exercise. It's an hour and a half per unit. Same thing is true for direct materials. When we talk about direct materials, we're not going to have time to finish this exercise today in class, so we'll pick up here on Thursday. But for direct materials, how much we need and what type of direct materials, who does that come from? Well, who designed the product? Maybe the engineers or the design staff. There's going to be a specification for this product that tells us exactly what direct materials and how much we should be using. This information in this table are referred to as the standards. This is what we expect to use. For a passenger car tire, 35 pounds of rubber and 5 pounds of steel belts. For a truck tire, 78 pounds of rubber and 8 pounds of steel belts. In our next chapter that we're covering next week, we'll be doing that analysis of, well, you said you were going to use 35 pounds of rubber, but you actually use 36 pounds. That's a variance. The other piece to this is not only how much of what materials we're using, but how much do we expect them to cost? So you'll notice the production budget didn't say anything about dollars. It was units only. These two budgets, direct materials, direct labor, and then the last one, the manufacturing overhead, we know that those are the costs of producing the product. That cost information, specifically for direct materials, is going to come from our supply chain people, the purchasing department. They're going to tell us what is the going rate for rubber at this time. And do we see any price increases coming this year? Or do we have a long-term agreement in place with our supplier that says, no, we're guaranteed the $1.20 per pound for the next 2 years? So that comes from purchasing or our supply chain people. So you can see, as we finish up here, you can see that the direct materials and direct labor budgets can really be prepared simultaneously because the information contained in each one of them comes from different sources. So as we're following the guidelines of participative budgeting, we're going to be going to those individuals and saying, what do we see for pricing? What do we to purchasing? To human resources, what do we expect for average wages for our direct labor workers this year, this period that we're budgeting for? So we'll stop here for today because we are almost out of time. Does anyone have any questions, comments, anything else? All right, well, thank you for being here. And if you can join us for the review session tomorrow morning, please go ahead and sign up in Starfish so that I know you're coming. And if you aren't able to make it, but we have one, then I will record it and let you know when the video is available. And I'll see you on Thursday. Same to you.